Hi, everybody, and welcome to the newest episode of Meet the VC. We're in series 2. I can't recall which episode this might be, so I'm not going to guess. But I'm really pleased to say we've got, yes, a UK investor or VC. And that is a rarity for us because we usually are much more exotic. Not that you're not exotic, Ollie, of course. I wouldn't want to level that at you, but
It's sunny. It's very sunny here today, mate. So it might as well be exotic.
yeah, well, okay. We're filming from the exotic location of the UK, both of us actually, as we currently stand, and I'm actually really excited to talk to you today, to Oli Hammond from Fuel Ventures. It's a pleasure to have you on, Ollie, and thank you for joining us today.
Yeah, no, of course. Thanks, Paul. Really appreciate you having me on.
No problems, no problems. So today, Ollie, I can't wait to get into the interview and into digging deeper into what makes you tick and the team at Fuel Ventures. But before we do that, what I wanted to do is just ask you about you, mate. And tell me a little bit about you and your background and sort of how you got to this position.
Yeah, of course. So my background's not necessarily a conventional background when it comes to venture. I very much came through the startup route, which I think even in the UK now is still actually a surprisingly underused route when it comes to accessing startup investing. A lot of investors come from high-end banking backgrounds or high-end finance backgrounds or consulting backgrounds or whatever it might be. I did a degree in war studies, which is effectively just slightly specialised history, at the University of Kent in Canterbury. I went into retail and commercial banking, which was great. I worked for a Swedish bank called Svenska Handelsbanken, who are Scandinavian, so they look after you. Lovely. And they're very, very lovely people, but it just wasn't the job for me. And I knew relatively early on it just wasn't suitable for what I wanted to do and for my skill set. So after a year, I left that business, and I actually joined a business that I found on Crowdcube at the time. I was browsing. I saw that they had raised their funding round. I thought, well, they've probably got a little bit of money so they can pay me something. And I dropped them a message, and I just said to them, I'll be a trench worker. I'll do whatever needs to be done. I didn't come, especially at that time, I didn't come from a specialised background. I wasn't going to be a CTO, a CRO, a head of product, or whatever it might be. So I just said, look, whatever you need doing, I'll be that person. I'll be the assistant. I will be the associate. I will be the whatever you need. And I was there for about 6 months until the business actually had to make a group of us redundant, which was fine. Is what it is. But I had such a fantastic time there. It was so dynamic. It was so creative. It was so different from what I was used to sitting behind the desk at the bank. That I decided that was the world that I wanted to stay into. I didn't really know much about venture capital at the time. I looked at the industry a little bit, and I actually made a couple of applications at the time for VC companies. And I look back now, and it was always the big ones, right? And I look back now, and I think, God, knowing what I know from this side of the table and how active people are with applying for roles at Fuel Ventures and things like that, and I know the sorts of talent I would have been coming up against in that process. And now I look back and I think, God, no wonder I never got through that first round of vetting. I actually ended up going to Cambridge, moving up to Cambridge and joining a platform, one of the, at the time, crowdfunding platforms called Syndicate Room. It's not a crowdfunding platform anymore. It's shifted into a co-investment fund model. But they were an early stage business. I was an early employee. I was working with loads of early stage founders who wanted to fund their business. And what a good time I had there. They were just great people, amazing atmosphere, really mucking mentality, which I like. That's really where I thrive. And I spent 3.5 years there. Ended up leading a team at Syndicate Room. We made that pivot to a co-investment model, and I decided at that point that I wanted to work more with managed funds. And so I knew a lot of people from the early venture capital scene. I knew Stan and Mark at Fuel Ventures very well. Fuel at the time was a very, very small fund. I think it deployed less than 20 million. And I saw somewhere in the crevices of the internet that they were looking for an associate to come in and help them with deal flow, and so I applied for that role, and I got it. And again, very early company, very raw, again another early stage business, and we've now grown Fuel to where it is today, which is deployed nearly 250 million of capital into UK-based seed stage businesses, which is I'm thrilled about. It's a achievement that I'm immensely proud of. But it's been a hell of a ride on the way.
It certainly has, and I think whilst you're kind of on this track, albeit I'm definitely going to come back, I'm going to pick away a little bit about you and how you got to Wadey, because there's some really interesting threads there in terms of your mentality and the way you've got to this point. But whilst you're there, just tell us a little bit more about Fuel Ventures, because I think, it's very easy for people to say we're different because of this and we're different because of that. But I think there is something, from our conversation previously, there's something really, really quite nice about Fuel and about the way you do things and see things. So tell us a little bit more about that.
Yeah, so we've got two primary funds. We've got a pre-seed fund, which is an SEIS vehicle, 250k max tickets, 30 to 40 deals a year, hyper diversified, very, very early stage. Now, that's not the fund that I manage. We try to keep some kind of semblance of wall between the two funds, obviously for conflict reasons, but we work very, very closely together, and I'm incredibly close with the team that run that fund. We launched that fund back in 2021, so it wasn't the primary fund for Fuel Ventures when we started, but it's become a big part of our story. The fund that I represent is what we refer to as the Scale-Up Fund, which is a seed stage EIS fund, £1 to £3 million tickets, 10 to 12 deals a year. So still pretty diversified, and we do that on a generalist basis. So we invest in all sorts of different sectors. Our official remit is platforms, marketplace, and SaaS model businesses, B2B and B2C, which when you start picking it apart is incredibly broad. And that's really by design. We want to make sure we can diversify really well at these early stages. And if you look at our portfolio, you'll see everything from enterprise software, fintech, marketing tech, marketplaces, prop tech, gaming, everything in between. There are a couple of sectors we don't touch. Medtech, biotech and pharmaceutical, crypto tokenization and NFT, although we've just made a couple of investments into stablecoins, stablecoin platforms, but we've never really gone further than that. And also hardware businesses. We do a little bit of direct to consumer, but that's got less and less as time has gone on. Hardware businesses in general are no for us. Founded by an ex-entrepreneur, and for us that's a really big boon, right? Like for us, it's something that really does differentiate us from a lot of the market. So we've got Mark, he founded his own company, which was called myvouchercodes.com, which is an online marketplace for vouchers and experiences. He sold that business back in 2014. He was a very active angel investor at that point. He didn't run a VC business, but he became an investor himself, and he really buzzed off of helping these founders. He brought people into his office. Some of his very earliest companies shared office space with him. When he exited My Voucher Codes, he decided that actually he no longer wanted to run his own, let's call it, conventional business. He wanted to go down the VC route and see what he could do there, because he liked working with this diverse group of founders and supporting them. And Mark is not just a face on our deck. He's a full-time member of our team. He's our CEO. He does all the work you would expect that person to do on a full-time basis, as well as being an investor in our funds and having a very strong private interest in the performance of our business as well. So the fact that I come from a background of working in startup companies, Fuel Ventures included within that. Mark comes from a background of an exited founder. We've got several other team members who come from that early stage startup background, alongside people that come from these more conventional or slightly larger corporate backgrounds as well. And that blend has really put us in a really good position, I think, in terms of understanding and empathy. And I think one of the things that as early stage investors gets neglected a lot is founder empathy, and not just founder empathy but team empathy. And actually I always say to people, if they want to get involved in VC a little bit more, you don't need to go and found a company. I think there's this sort of idea that you need to be a founder and you need to be successful or at least semi-successful, and then you can pivot into VC. Actually, there is an incredibly different experience between being a founder of a business and being a early stage team member of that business. And it's a different skill set. unfortunately for the founder, you're not necessarily around that table in the pub on a Thursday night listening to people moaning like, you don't see the dynamics that go on between the trench workers within your business, because everyone's going to smile and everyone's going to tell you that they're having a good time and everyone's going to tell you it's positive.
Yeah, of course.
So actually, that's been a really, really big thing for us. It's having that mixture of not only startup and non-startup, but experience within businesses as well.
I agree.
Startups.
I agree, and I think the the generalist element is to some people surprising these days, because a lot of investors, VCs, they lean into specific kind of niches or specific markets. And obviously I've spent a little bit of time speaking to you, and you've kind of alluded to this already around this founder focus. Obviously Mark's background, your background, the company here is really hyper focused on the founders, and I think that's a super smart way to be in terms of early investment, and I can see why you've been so successful with it, because ultimately at this stage, regardless of whatever numbers get thrown out there, right, nothing can really be proven, because you've like ultimately the businesses haven't been around long enough to prove those numbers or prove that, and so the focus on the founders is really, really important, and building those relationships. And I think one of the questions I wanted to ask you in respect of that was, how do you approach building those relationships with founders, and what qualities do you look for in potential investments within those relationships?
Yeah, so building founder relationships is the most important part of what we do, and I think it's a part that's generally overlooked. I agree. Investor skill sets, people tend to leverage heavy on financial backgrounds. The reality is of our situation as a seed investor is that financial backgrounds, to a certain extent, are relatively worthless. Like, I'll be honest, it's relatively worthless. As long as you've got a working understanding of how a company balance sheet works, and a basic understanding of how to read and interpret a financial model, then actually beyond that, at seed, the rest is guesswork. And actually, if you're at Series B or Series C, that skill set changes.
I agree.
Very, very fundamentally. But a skill that gets widely overlooked, and I don't know why it gets overlooked, I think it's because people assume it's simple, and it's not simple. My experience of business is that it's not simple at all, and a lot of people are very, very bad at it. But it's building and maintaining professional and personal relationships with founders. And the relationship that I have with the founders that I work with is a professional relationship, but there is a hybrid mix at seed that needs to be recognised, which is there is a hybrid mix between a professional and a personal relationship.
Yeah.
Because fundamentally what these founders are asking you to do is to trust. They want to trust you with what is an incredibly big part of their lives and an incredibly big part of their future. And how that goes, how that business goes, and how that business develops fundamentally changes how the rest of their life pans out.
I agree.
And you almost can't do that on professional relationships alone, because there has to be a very significant trust element, especially at the very early stages of business. What a lot of people are incredibly bad at, in my experience, is developing personal relationships alongside professional relationships. It has to be one or the other. A lot of people are very, very black and white. And what I see in a lot of early stage deal flow is a lot of businesses or a lot of people lose deals on the basis that they can't develop healthy personal relationships with people who they see as professional assets as opposed to personal assets. That doesn't work. The best founders don't want to work with that person. They want to know that professionally you're going to be there, you're going to turn up, you're going to be there at 10 a.m. on the Wednesday when you've got the meeting, and you're going to take part, and you're going to ask hard questions, you're going to respond positively and proactively to hard discussions. And at the same time, they want to go out for the beer on a Thursday. They want to be able to come to you, because being a founder is a lonely job. It's lonely. It is a horrible job. And actually, you have to have real guts of steel in order to deal with it on a day-to-day basis. What they don't want is, we're all adults here, right? They don't want someone shouting. I can't sit there and shout at someone, right? That's not my job. My job is not to tell you off. My job is to be as supportive a team member as I can, and that blend can really, really struggle with some people.
Yeah.
So that's really when and I'm sorry, I've deviated from the question there slightly, but in terms of what we're looking for from our founders, and I'll go into, I guess, let's call it the subjective nature of what we want to see within founders. But ultimately, we need to be able to get on with these founders for days and months and years post our investment. We need to be able to trust them. We need to be able to believe in what they say, and we need to be able to build that relationship with them, because with that relationship comes the ability for us to help them more and support them beyond just business. Support them in a way where actually they can come to us and they can talk about when things are going wrong, and they know that they're going to get good response, positive response from us, and they're not going to be shouted at like their children.
Yes.
Within the founders themselves, I'm not going to say anything absolutely groundbreaking here, I'm afraid. I wish I could, but I can't. Because fundamentally, what it comes from is experience. That's why I think when building VCs, a mixture of experience is super, super important. Because what you need to be able to do is you need to be able to cut through honeymoon periods pretty quickly and get to the nitty-gritty of whether the founders are the right founders in order to build the business that you want them to build. And there are some slightly more objective things that we as investors can look at. So, for example, we can look at previous founder successes. Have they worked in successful businesses previously? Have they run their own companies previously? If they've run those companies, have they received outlier returns previously? Now, 99.99% of founders aren't going to tick that box, but even if they haven't received outlier returns, have they received some kind of return from that business? We know that statistically founders that have had previous returns on businesses and previous exits, regardless of if they were outliers or not, are more likely to return outlier businesses in the future. What kind of backgrounds do all the individual founders come from, and are we seeing a good spread of talent, or do we have 3 CTOs within a company, which can become quite problematic quite quickly? 1, because they're arguing about product, and 2, because they can't sell anything. Are we seeing a decent spread in terms of educational background?
Yeah.
We do founders who are founders specialised in their specific areas, i.e., like, are we backing a founder that in a logistics startup that comes from a logistics background or has experience in that? Now, again, all investors differ. Some investors say, like, well, we want people that are going to completely break the mold, and so we don't want people with that background. I think Costler Ventures are a really famous example of that. Actually, at Fuel, we don't necessarily agree with that, and our thesis is that we do like to see people with at least some fundamental experience in their background, because the amount of nuance, especially in these old school industries, is incredibly high. And actually what we want people to come and say, look, I've seen this problem on a day-by-day basis, or I've experienced this problem in a case-by-case situation. So judging founder fit and judging suitable founders is a complete art, and that is why more times than we'll get it wrong more times than we get it right.
Yeah, and I think that's really fair. Can you share an example of a startup that you've invested in and how you've supported their growth beyond just the financial backing?
So, the concept of support beyond financial backing is the thing that all VCs want to try and achieve, because especially between 2019 and 2021, it was really the only thing that differentiates people. Not so much in the current market. In the current market, ticket size really does matter. The ability to follow on really does matter. But obviously what we all aim to do is we aim to support our companies as much as we can. Now, the thing that I will say about me as a seed investor specifically is I want to be nothing more than a periphery player in your business. Because when you get to Series A and Series B, or especially Series B and Series C, you'll find that the investors become intrinsically very heavily involved. And that's for obvious reasons, right? They've got much bigger tickets, and the tickets generally much more concentrated. Whereas for me, my portfolio protection comes from diversification of the portfolio. It's by writing 12 £1.5 million tickets a year, not by writing 3 £10 million tickets a year. So I don't want to be anything more than a periphery player. I don't have time to be anything more than a periphery player within your business. So what we like to do instead is, 1, we don't want to tread on your toes too much. ultimately, if we don't think the founders are the right founders to get the job done between seed and Series A, of course they'll have our support, and of course we'll do what we can. But if we don't think they've fundamentally got the ability to do that, then we're not going to invest anyway. It makes no sense for us to do that. You know, we can't invest in a business because we like the idea and we don't like the founders, because then what we're just doing is taking on a massive burden, which we can't do. You know, running a startup business, especially at this kind of scale, is beyond a full-time job. But what we try to do is we try to leverage our internal network as much as we possibly can. So we have founder Slack channels, we do founder events, we have monthly meetings with our portfolio companies, especially the ones where we've recently invested, usually within the last 18 months. Once they've gone past Series A, generally that scheme is set up by the new investor, the new lead investor coming in. And within those meetings, we'll get companies that say to us, oh, well, I'm having XYZ problem. We can go, oh, great, actually, ABC Limited had XYZ problem. So actually, let me connect you with, Steve at ABC Limited, and you guys can have that conversation. I'm not going to tell you what Steve did, because Steve is going to have a bunch of information that I don't have. So what I'm going to do is I'm going to connect you to Steve, and Steve can take you through what they did and how they fixed that problem. We try to do things like get the best deals for our founders. So we've got a platform that we use in order to try and get as many discounts and references for our founders as they possibly can for key services, things like legal services, marketing services, pay-per-click services, things like that, so they can use their money as effectively as possible. And accessibility. Accessibility really is our key function. So whenever a founder comes to us and says, guys, I've got a problem, we have that monthly meeting with our founders, but really what we want is, guys, if there's a problem, you WhatsApp us. Just let us know. Drop us a note. There's a WhatsApp group where it's got all of us on, and we're for your business. And drop us a note in the WhatsApp group, and what we'll do is we'll go out, even if we go out internally to everyone within Fuel Ventures and say, does anyone know XYZ person who could potentially help this company? And we'll go out and we'll do that. It's just about being a master connector, trying to help as much as possible. We don't need to know everything. We just need to know people that know everything. And then we want to make that connection as quickly as possible and as efficiently as possible with positively reviewed partners. And that's what we aim to do.
Yeah, I really like that idea, and what I love about your kind of methodology there is that you start with, we understand that we're not the big player here, we're a seed investor, and so part of your kind of methodology is we're not going to take up too much of your time, but what we are going to do is we're going to support you, and we're going to support you where you need to be supported, and I love that idea. But in terms then of you, so I see how you support them from a point of view in terms of the WhatsApp groups and the Slack groups and however that works. But how do you stay informed then about emerging trends and industries to identify the most promising kind of opportunities?
It's so difficult, and it's really unbelievable. And I don't mean...
Especially as a generalist.
Not only is it unbelievably difficult, it's unbelievably expensive.
Yeah.
The problem is that, so I could talk to you, I do like to keep on track with the news. So, and by the news, I mean TechCrunch and Sifted rather than BBC. That's great, and that's fine, and that's super helpful. But the reality is, if it's in one of those, if it's in a publication, it's probably already too late, because the publication discusses the outcomes of our industry, i.e., they'll talk, if they want to talk about defence tech, they'll talk about, Helsing, something like that. Now, that's a business that's already a multi-billion-dollar business, right? So, that was an investment that was made 4 years ago. They are the reporting. The reporting community within venture is very, very helpful and very useful. But for people like me, it can sometimes be a little bit late. Even though I do like reading the content, and I do think the content can be very helpful when informing opinions on certain sectors or certain spaces. The reality of the situation is that for early stage funds, keeping on top of trends mainly actually comes from talking to companies. So it comes from our day-to-day job.
Yeah.
So, and when we speak to a company, and when we speak to a company that we think is potentially interesting, it's going out and getting the reviews of qualified people. So I'll take an example from this morning. I had a call with a company this morning in a sector that I know very, very little about. But I know that it's a sector that I've got a couple of founders in the portfolio who have previous experience within that sector. And so I messaged them. I just dropped them a note and said, guys, I've just looked at this company, XYZ, here's the founder, background, blah, blah, blah. What do you think? And they can come back and they can say, and as you know, from our founders, we get a really, really diverse group. Some of them come back and say, Ollie, it's not going to go anywhere. And the reason it's not going to go anywhere is because of this. You know, there is a piece of regulation, there's a piece of legislation, or actually they've got a couple of people on their competitor slide, but in our business, which is one of the biggest businesses in the space, we actually used another person that they haven't mentioned at all. And they fixed that problem. They've been fixing that problem in the market for several years. Or they come back and say, super background, super founder background, really interesting problem to fix. It was a massive problem when I was in this space. So actually, it's the founders that really inform modern trends, current trends. And that's where we get most of our information from about what's coming around the corner.
And do you know something? You're not the first. You're not the first investor to say this, and I think it's so true because we're in an age now where things are moving so quickly that it's almost impossible to stay in front of it anyway. And real time information is the key. And so yeah, I completely get that. This is an interesting one for you, especially. I really can't wait for the answer to this. But can you share a specific investment decision that you made that didn't go as planned, and what you learned from that experience?
So none of our investment decisions go as planned. That's the first thing. None of our investment decisions go as planned. And
None of them.
the vast majority of decisions that don't go as planned will not go as planned negatively. I.e., like the company will just not reach its targets, the company will struggle to grow. Again, that's the nature of being a seed investor, right? We accept that as a key part of our job. And just because a company doesn't grow or accelerate as fast as they expect to, because this you get, I mean, you've seen this Paul before in some of the companies you've worked with, these fantastical plans of perfect growth.
Yeah.
When's that actually going to happen? It doesn't. It's not going to happen. Doesn't mean the company's not going to work out or is going to be a dud, right? It might just be a bit slower, or it might be a little bit different, or it might be, it might not be a £1 billion company in 5 years. It might be a £200 million company in 5 years. You know, that's the nature of what we do. There are cases where it doesn't go to plan and it goes positively, but what I can almost guarantee you is that it's never going to go to plan because the plans are relatively perfect instances of what may or may not happen.
Yeah.
Because ultimately you're doing a lot of guesswork and you have to make some assumptions about what's going to happen, and the level of curveball that we have is drastically.
Yeah.
Now I know what you're getting at. You're getting at when a business didn't to a negative aspect didn't go to plan. What have we learned from that experience? Well, it kind of depends how it didn't negatively go to plan. We try and do a diagnostic of every, or we do a diagnostic of every business that fails within our portfolio and why it failed. It's very, very rare that we look back on a business and we say, actually, we think we got the market entirely wrong. We don't think that was the right market. We completely misjudged it. Because usually when we're investing, we can generally find some examples of companies in that space that have done a lot better and succeeded a lot better. So then it comes down to all sorts of other reasons, right? And that can be anything, right? That can be founder fallout. You know, very common in early stage businesses, right? The founders didn't get on, they fell out. That caused a very prolonged discussion about who's going to take what over and who's going to stay within the business and who's not going to stay within the business and who gets what equity and yada, yada, yada. It could be things like lack of product market fit. You know, we're not getting the sales that we need in order to go and raise the next round of funding, and the business was unsustainable in that nature. It could be a really key one for me, and again something that's driven how I look at businesses is there have been times historically where we've had founders that have got other interests. And actually what we've done is we've looked at those other interests and we've talked about how those other interests could support the core business. But actually over time, as the core business has not performed the way that we wanted it to perform, those other interests suddenly start to become a lot more attractive because that's what puts food on the table for those founders. And actually that's where they start spending more and more time maybe looking over here rather than looking at what we want them to look at. And so actually that drives some of our decision making now in terms of how we make investment decisions. So the reality is none of our stuff ever works to plan.
No.
The majority of it doesn't work to plan to a negative capacity. And there's a lesson in all of it. And those lessons are almost entirely unique in terms of how those businesses have failed.
Well, do you know something? It's really interesting that you say that they all that none of them go to plan, because I think it was certainly it was somebody. It was an investor that I spoke to quite recently. I don't know if it was actually on one of the shows, but it rang so true to me that kind of the number one thing that you need from a founder is that kind of resilience, or that ability to pivot, right, and to deal with the challenges that come up, because ultimately they're gonna come. Like and 9 out of 10 times, the business that it started as that seed business, it actually finishes nowhere near that, and they pivot 2 or 3 times, and so that ability to actually know that challenge is coming. As a founder, that those challenges are coming, and you might fall out with a co-founder, you might hit a cash flow problem, you might hit a development problem, you might suddenly have your customer acquisition costs raise, and that you might need to pivot. That the ability to do that is actually one of the main things that any founder needs, because it's definitely coming.
Absolutely. The strength of a startup is not being relentlessly regimented to a single plan or to the original plan. It's that flexibility, and we've seen it as little as we're going to take the same products and we're going to target a slightly different demographic, and we've seen it as drastic as I'm trashing my business completely and starting from scratch.
Yeah, exactly. I agree completely, and I think it's not being wedded to these ideas or to this kind of romantic idea of the way the business is going to be, and actually looking at, well, the market we really need to be in is this one, and so we might have to rip it up and move on, and having the bravery to do that. But I think that I think that the founders being kind of ready for that is really key. What advice would you give to early stage founders who are looking to raise capital for the very first time? Run to the hills.
Yeah, the key element here is for the first time. Right?
Yeah,
that's
for the first time.
And there's a couple of things that I see happen quite frequently that I always recommend not to do. So the first is that a lot of founders come to us and they say, I'm raising X amount of pounds at X valuation. Do not value your business publicly, because that is not your job, to be frank. Like, it's the moment you value your business, you're going to really probably achieve one of two things. Number one, you're going to scare away a potential investor. They're going to look at it and be like, I think that's overvalued, and therefore I'm not interested anymore, and I'm going to walk away. And you're never going to have the opportunity to push your case or to tell someone why your business is a really, really good business. Or you're going to cap yourself. So what you're going to do is you're going to say, if you say I'm raising £1 million at a £5 million pre, you are never going to get more than £5 million pre, because people are going to say, well, that's what you valued your business at. Like, that's it. Like, you're never going to get more than that. I don't think that setting a valuation on your business is the right thing to do. I think you need to understand what you're asking for, and then you need to work with whoever ends up being that lead investor in terms of how that business is valued. On a similar thread, make sure you understand what common dilution looks like at that early stage. Because, and again, it's quite common, we get people that come and say like, oh, I want to raise £1.5 million for 5% of my business. Now, that goes back to the first point of you valuing your business. But also what happens is 5% is not a realistic dilution figure for early stage investments. My standard is anywhere between 15 and 20%. And the reason is because that's how the maths works. I can't. If you were 5%, five, if I took 5% in your company and I diluted by 50% over the course of you being a £1 billion business, I deploy 25 million a year. I've got 2.5% of your business, and your business is a £1 billion business, right? Now, keep in mind, if you as an investor have £1 billion business in your portfolio, you've outperformed 95% of the market, 95% of the market, right? So that's a real success story for you. But I've got 2.5%. So for that £1 billion business, for that outlier business that I backed at seed, I've paid back my fund. I haven't even made the hurdle rate to start getting paid on that. So I've had a unicorn company exit in my portfolio and I haven't made any money. I'd like to get out of bed for that. Do you know what I mean? That's you need to understand the core dynamics of how these funds work. Because if you start expecting that they're happy walking away with a couple of percent equity, especially if they're a fund that's generally deploying that, like I said, 25 million a year, 30 million a year, it's not going to work. And actually what you're going to do is end up very disappointed.
Do you know something, Ollie? That is, honestly, we need that. What you just said there needs to be clipped and played over and over again, because I would say it's certainly the top 3 questions that gets asked of us, right? When we're talking to clients who are looking to raise capital, it always comes back to, okay, what should I value the business at? And what percentage is realistic in terms of moving forwards? Yeah. And what I tend to say is just removing the emotion from the conversation, removing that kind of, should we, shouldn't we, how do we do it? I say, I quite often go into, well, what you've got to do is look at it through the investor's lens. Like, what is it that they need to get out of this?
Absolutely.
And that is the first time that I've heard it sort of framed in the way you've just done it there, which is like, listen, guys, we can't come in at 5% because 5% gets diluted down to this. That means that even if, we get the one moonshot that this fund ever is likely to get, and we're probably not going to get 2 unicorns out of this fund, right? Yeah. Because realistically, we're investing at seed, right? So if we get 1 and we don't make a penny on that, then we have completely failed.
Yeah, absolutely.
And that's interesting.
And it becomes a bit of a sore topic, because I think the idea that we're not charities, right? Like, ultimately we are here. If we don't make money for our investors, we don't raise more money. And if we don't raise more money, then we don't get to back other fantastic businesses who really deserve that shot at scale growth. And that's what's become the problem in the market, right? Poor investor returns have become a massive problem in the market. Lack of liquidity, things like that. So we've always got to think of that, because, there is a selfish element to it. We as a business want to make money. That's our job. That's what we're here to do. That's what everyone's here to do when they're building a business. But also there is a altruistic element to it, in that if we don't make the return profile, we can't raise more money. If we can't raise more money, we can't back more great people who are looking to build incredible businesses.
Exactly. Yeah.
It's a hard truth, and that's why a lot of businesses are not suitable for VC. Not because they're bad businesses. We as VCs, we are not the arbiter of good and bad business, because there are plenty of businesses out there that are worth 50 million, 100 million, 150 million. Amazing companies that are providing life-changing results for the people that found them, that aren't suitable for VC money.
Yeah, I agree.
Because of the massive amount of fund returns.
I would say, I've said this before to you, we probably speak to between 20 and 40 founders per week, face-to-face, on video calls usually, or face-to-face meetings. And I would say we only even consider working with 1 in 10, 1 in 12 of those. For that exact reason. And most of the time, it's not that the business isn't a great business, it's just the fact that it isn't the right thing for them to be raising money. They don't have the time. They're never going to be a business that an investor would want to invest in. That that it may be that they can build something, it's wonderful, and they can build it to a £10 million exit, which is wonderful for a founder to be able to build that business. But it's not backable. It's not something that is going to be backed.
Absolutely. And actually, Paul, just on your original question, I think the third thing that I would say for people that were looking to raise money for the very first time is that traction really is everything. We work in a very, very PR-heavy industry. The industry is just dominated by PR, and that PR generally centers around XYZ company has raised ridiculous amount at ridiculously early stage for ridiculous valuation because of human in the business, right?
Yeah.
Most people, vast majority of people can't compare and can't compete with that. And if you are fundraising for the first time, then you are likely to, and I mentioned some of the indicators earlier, right, in terms of like successful previous businesses and things like that, that all comes into it. But if you're raising really like serious VC money for the first time, you haven't gone on that journey before, there really is no comparison when it comes to traction. And actually, again, one of the mistakes that we see a lot are people that say, well, that company over there, pointing to this ridiculous sort of media article, PR article, like I said, there's tons of it in the industry. Well, they raised at X valuation and raised X amount of money, and I'm doing it exactly the same, but I'm just raising 20% less with a 20% lower valuation. And it's just like, guys, like, you're coming in as a pre-revenue business, and you're sort of saying like, well, I'm comparing myself to that company over there, and actually you're not particularly comparable because of the pedigree of founders over there. They've proved themselves XYZ times, and you haven't necessarily done that yet. And actually, I say to a lot of founders that really like just having some semblance of traction, early revenue, early customers, early evangelists within that business,
a wait list.
Stuff like that. Like the chances of anyone raising that round that's been PR'd about is very, 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 very low. Do not base your business model and do not base your future success on being the outlier, and before you are the outlier, raising the crazy outlier round, because it's probably not going to work for you.
Yeah.
Do it instead on a basis of traction. Traction is, in 99% of the cases of rounds that I see, is really what attracts the investor, because it's something that they can get tangibly excited about. And it's hands-on. Like, I can call the customer and I can say, why are you paying for this? Why is this important for you? I can mitigate a huge amount of DD by not relying on you to give me the information, but going to the customer themselves and asking them why this is a super important product for them.
Yeah. How do you envision the future of venture capital evolving, and what implications do you think that will have on startups and the overall investment landscape?
So, my controversial take on the market is that, and I would say this, right, because it's fundamentally in my interest, but it's very, very hard to replace CVC with AI. Very, very hard, because it's too subjective. There's not enough numbers, there's not enough data, there's not enough... AI does a fantastic job of sourcing interesting businesses, pointing out, fundamentally, oh, well, they're quite interesting, oh, well, they're quite interesting. Their follower count on Twitter or Instagram or LinkedIn has grown X% over the last 2 months. Great. Like, it's a great way to indicate who's coming out of the woodwork and who's really starting to roll. But I don't think it's going to fundamentally replace the relationship needed in order to be a successful seed investor. I don't think it's going to encourage early stage founders to give up parts of a really early, really important part of their life. And I think it would be a poor converter. I think it's a good indicator. I think it's good for pulling out information. I think it will be a poor converter of high quality deals.
Yeah.
So at seed, I don't think what we're going to see is radical changes in core structures through the use of AI. I think what we're going to see is radical changes in the speed of due diligence, the accuracy of due diligence, and the way that we question early stage businesses. ultimately, though, venture is, like a lot of industries, cyclical. So I think at some point we're going to go back to the 2019 and the 2020 market, where there is going to be a lot of cash in the market and venture is going to be relatively flush again. And what we're going to see is we're going to see a lot of people come out of the woodwork. They're going to try and set up new venture funds. There's going to be a lot of money in the market. We're going to start to see this sort of slightly crazy, hyperinflated market again. Although we are seeing that now with some AI businesses, but
I agree.
Select. I think what I'm saying more than anything else is I don't see market dynamics drastically changing.
No.
I think the only thing that really drastically changes the venture market, is slightly external factors, mainly the exit market, the IPO market,
Yeah.
and the
Yeah.
venture market. That's the real crux of what changes venture, what goes into venture, and what comes out of it.
I agree completely. I think you've nailed it there. For me, bearing in mind the deals that we kind of, we're discussing and we're working through, sort of from those seed right through to kind of 50 million plus, check sizes, and a project at the moment that's going to go right up to about 225 million across a 12-18 month sort of horizon. To me, I can see a point whereby AI will be able to do a lot of the heavy lifting on those later deals, just because there's so many data points within there. There's so many like visible and attributable data points that you can pick up and say, well, we can pick up like the financial trajectory of businesses really, really quickly, and those numbers. And of course, a lot of the mitigation within and the risk is less about people in those businesses and more about kind of all of those data points. But I do agree with you wholeheartedly that at the front end, the way that you go about this in terms of that focus on the founder and those relationships, there is no AI that's going to replicate that piece, and I still think that even in those later deals, there's a huge element of human involvement. But I think that on a sliding scale, you'll have less AI at the front end at seed, more AI as you go further down that line, and it's probably the other way around in terms of human involvement, like much more human involvement at the seed, and then less and less and less towards the end there.
I think AI at the later stages is going to actually be quite helpful.
I agree.
The later stages is the length of time it takes in order to close deals. So actually, I think if you had a model that could, if you had an agent that could scroll through a entire data room and flag key problem points, do in-depth financial analysis and do market comparison, I think what you're fundamentally going to do is you're going to end up saving a lot of time, and I think that's going to be a lot better for the companies in the market. I think for the investors, it could be problematic. And the reason I think it could be problematic is it becomes a real like change or die mentality. Because if you don't become an early adopter, what you're going to end up doing is you're going to end up losing a huge amount of deal flow on the basis that you can't keep up. Your operations are going to be too slow, and actually what you're going to find is that the companies that you want to invest in are going to get term sheets incredibly quickly.
I agree.
Because the AI agent within another
it's going to be working through. They're going to be working all night, and you're going to be waking up in the morning.
Yeah, they're going to get a full due diligence, a confident due diligence breakdown of a company in 24 hours, which previously would have taken them 3 months.
Yeah, I agree. Oli, we have run out of time, my friend. What a wonderful, wonderful conversation. I can't thank you enough for your time today and your insight. I can't wait actually to go back through the edits on this, because you've given so much value there and so much information. Really, really appreciate it, and as I'm sure our founder community will appreciate it as well.
Yeah, no problem at all, Paul. Thanks for having me, mate. I really appreciate it. Always good to have a nice chat with you.
Thank you,
So,
mate.
yeah, really appreciate it, mate. And listen, I'm sure I'll get some reach outs from people and things like that. But obviously, happy to deal with any follow up questions that people have as well.
Absolutely. Thanks a lot, Ollie, and all the best to you. And yeah, let's until the next time, guys. Goodbye.
Cheers, guys. Bye.